solicitor and Spanish lawyer with my law in Spain. And on the call today, I have my colleagues, Isabel, Rosario, and Patricia. Patricia, all there. Okay, and basically where are we as far as the crisis is concerned? Well, hopefully the Malaga province will be moving to phase 1 on Monday. We should learn a bit more about that over the weekend, but that would mean that basically families will be able to see each other, friends will be able to get together, up to 10 people, and bars, hotels and restaurants will be open. We still won't be able to cross the provincial line, but life will hopefully become a little bit easier. So we'll learn a bit more about that over the coming days. As we've been in lockdown, Zoom has become very popular, and this is one of many seminars that we've organised. And today we're really pleased to welcome on the call the team from Black Tower. So welcome, Tim. Would you like to introduce yourself and your colleagues, please?
Thank you very much for having us here, Alex. I'm very pleased with that. Thank you very much. My name is Tim Govertz. I'm from Belgium, so I'm afraid you'll have to get used to my accent during the call now. And I'm the Associate Director for Black Tower Financial Management. Just to give you a very brief introduction to who we are, what we do. We've got a team of 8 consultants here and a number of admin staff here in our office in Marbella. And we provide financial advice. We help our clients achieve their financial goals. We've been doing so for over 30 years, and we've got offices across Europe, since a few years in the Americas as well. And here specifically, our office is in Marbella. And beside our office in Marbella, we've got an office in Barcelona, Murcia, and Costa Blanca. So obviously today we're going to talk about the markets, I understand, predominantly, but apart from that, we look at the whole picture really. So we look at tax implications, pensions, residency issues, and that's how we help people really. So we take a holistic approach to person's financial situation. We've got a solid team here, and today I brought 2 with me that will answer a number of questions as well. That's Lucia Melgarejo and Richard Mills, who I understand is showing right now.
Am I? Right. Afternoon, everybody.
Hi, Richard. And where's Lucia? Ah, there she is.
Good afternoon.
Hi, Richard.
There you go. Excellent. Welcome. So, Tim, let's get stuck in. I mean, basically, anyone who wants to ask a question, if you can either put that in the chat box or wait till whoever's talking has finished, and then you can ask the question. We are recording this session, and we'll be placing out on our social media outlets after this. If you've got a very personal question, personal circumstances, then you can of course contact us or the Black Tower team directly. But here today we're talking really about minding your money and general matters that you said, Tim: taxes, investments, residency, and of course legal matters with the My Law in Spain team on. So let's hit off with, we've all seen the headlines with the bad news of the markets, Tim. What can you explain a bit about how the markets have moved recently and why?
Right. Well, the markets were doing very well until about February. So we've had a long bull market, as we call it. The bull market is when there's a prolonged growth in the market. And we've had so for a number of years. So we've been spoiled recently, really. And then obviously, suddenly Corona came. So first in Wuhan, in China, then it spread across to Italy. And then one thing, when we talk about the markets, we talk about the stock markets. And stock markets is a reflection of how the value of the companies that compose these stock markets moves and fluctuates. And what markets don't like is uncertainty. And with the virus came uncertainty. So we saw quite a steep drop in the markets between February up till the 3rd week of March. And then since March up till now, we've seen a slight recovery. Just to give you a few figures there that I dotted down here. The FTSE 100 is the main stock market index of the UK that we're all probably familiar with. We started off the FTSE at a level of 7,604. Now that number doesn't say anything, but just to put it in perspective, between 1st of January and 23rd of March, when it hit rock bottom, we had a decline of 35% when the FTSE went below 5,000. That's a massive reduction in value of those companies that compose a FTSE. And that's pretty much across the globe that happened. There's another index, which is basically an index of all the global indices. It's called the MSCI World Index. It's a composite index, and it reflects how stock market indices across the world move. And that declined between that same time frame, also with about a third of its value. To be correct, 32.6% was a reduction in value. Between that rock bottom on the 23rd of March and now, we've seen a gradual increase again in the value of those indices. So the FTSE went up since by 16%, and then the MSCI World Index by 25%. So what that really tells us is the speed of the change. So when they say this has never happened before, this is unprecedented, we need to be very careful with these terms, not to jump into some conclusions, but the speed that this move has, that we've seen, is really unseen. And it really shows, it reflects how quick we went from a functioning economy to pretty much house arrest, if that makes sense. So that's, and that's really where we are right now.
Hi, Tim. Hello. And can you explain why this has happened?
Well, if you think about stock markets and an economy in general, an economy is all about money flowing around the system, and people spending, and businesses having a cash flow and making money, etc. And doing what we're doing right now, being at home, confined to our houses, we can't spend anymore. So that entire economy of cash flow stopped, that flow of funds stopped suddenly. Obviously, if that's for a very short period of time, then companies and economies alike can absorb that liquidity. But when that's for a prolonged period of time, then we get into a situation where companies can become insolvent, and insolvency becomes an issue. And if we think about Federal Reserve, Jerome Powell earlier this week, he issued a concern about the long-term effect that this will have on the economy, because obviously the cash flow has now stopped, but the longer this takes, the more that we will see how businesses will be able or not able to survive. So when we talk about markets, they say markets don't like uncertainty, but in many ways, stock markets that move with a lot has to do with emotions, so it's a reflection of the perception of the economies rather than the economy itself. Markets, they tend to balance possible outcomes. So, and with regards to this crisis that we're having right now, we don't have, initially, we didn't have any outlook or any idea of what the possible outcome of this crisis would be. And this uncertainty has caused that the markets really assumed the worst case scenario. And that's why the markets have dropped so quickly, because they just assumed the worst case scenario. Because when we got some more, a bit more information about China, how they're handling it, how Italy is coping with it, then we see that there was already a recovery. Funny enough, actually, the markets were already going back up long before we reached the peak in infections and death. And that's purely because the markets were getting some form of an idea of possible outcomes. They didn't know about it, but the fact that there was more information at hand made already the markets move back up. And that's what caused really the steep decline in the first place, and the subsequent recovery secondly. The volatility that we've seen has been really extreme. Again, to touch on unprecedented events, it's not only the speed with of how the markets declined, but for example, also unemployment figures. If you look at the unemployment figures, how they've increased over the past weeks, that's never happened. That's not happened in the financial crisis, not with the dot-com bubble, not with any crisis that we've seen before, that the number of unemployed people has risen so far. So, and that's a reflection in the markets, in the speed with how fast they have moved recently. Does that make sense?
Yeah. Tim, what do you think would be the main difference with these other recent turbulences that you mentioned? So what is it similar? Is it's different? What is the main difference, you think?
I think the main difference is that this time if you're comparing it with, for example, the most recent crisis that we've had was the financial crisis in 2008, or before that, the dot-com bubble, the technology bubble that we had just after the millennium. There was a clear reason why markets crashed back then. The reason with the dot-com bubble was that technology companies were massively overvalued. They didn't have to have any intrinsic value. They didn't have to make a profit. It was just anything that had a label IT on it was just growing and growing and growing, and it didn't make sense to the value to which they grew. The same happened really with the financial crisis. Banks, credit institutions were massively overvalued, so that had to implode at some stage. So in the US, you had the issue with the subprime mortgages, that people who could not afford to buy a property were buying a property with a mortgage attached to that they never would be able to repay. So there was a clear structural problem. Right now, there was no structural problem. It was purely an external cause that triggered it, being this virus and the uncertainty and the sudden stop in the economy. And that's a big difference, I think. I think when we talk about a crisis and how it's going to develop, well, this is really the main difference with previous crises. I mean, we've all learned from these previous crises. If we look at with the banks, for example, the banks, their capital ratios need to be much higher than before. There's much more control in place. So markets are in that way much better off than they were before, and have been able to reduce the risk in the markets. But at the moment, all of that was irrelevant really with this new scenario that we're in now. Exactly.
Hi, Tim, and how do you see this evolve in the coming weeks and months, and what we can expect?
Well, I can't see in a crystal ball, obviously, but I think we're in for a lot more volatility. If you look at how markets behave on an intraday basis, we've seen more movements of 3% plus this year than in the previous 4 years probably combined. So, and that still reflects the uncertainty. I mean, also if you think about how to tackle this, if you think about the governments and the politicians, I wouldn't want to be in a politician's their shoes or in the government's their shoes, because on one hand you've got these health concerns, and on the other hand you've got these economical concerns, and balancing the two is really difficult. And that's where we are right now. We've had the confinement and trying to limit the health implications, but now it's starting to become an issue. The economy is starting to become an issue, because the longer that this will take, the more companies will fail, and that will have an impact, a massive impact long term. So to get it right is really difficult, but I think the pressure is on really now to get the economy to start again. There's been a lot of monetary help, there's been a lot of fiscal help. Worldwide, there's been approximately $8 trillion pumped into the economies via the different central banks. That's massive. That's a multiple of what's being pumped into the economies with the financial crisis. That what was pumped back then into the economies is dwarfed by all the measures already in place right now. That will find its way to the economy, to us, to investors. In first instance to the banks that will give that out as loans to businesses that are at risk at the moment, to try and help them survive and get through this. Yes, And whether that's going to help and be sufficient, we don't know. I think for the politicians, it's very hard to get it right, as we've never had this before. So it will be a lot of trial and error, changing rules. There's obviously also the risk of a second wave. Once we are all out again, how will that impact on the economy? We don't know. I think we've hit rock bottom. I don't think we will return to rock bottom for the reasons that I just mentioned. There's still a lot of uncertainties, but there's more possible outcomes that we're dealing with. And individual companies can look at their possible outcome. I think companies with strong balance sheets will survive. I think we'll see a shift in how that companies operate. I think we see shorter supply chains, for example. I think sustainability becomes very much also a criterion. So I think good companies will survive, and that's where the opportunity lies, and that's what will stimulate the economy. But in the meantime, we'll still have a lot of volatility. But I don't think we will have a second drop to where we were on the 23rd of March, if that makes sense.
That's interesting, Tim. Thanks for that. So just to give us an idea, what nationality are your clients? Do they live in Spain? Do they live abroad? And how is the crisis affecting your clients now? And did they panic? Because when you see the stock market come down by 30%, way before, like you said, the top of infections, before infections hit their peak, surely then when you saw at the bottom of the market, you would have thought, gosh, we're not at the bottom yet, it's going to go down even further. So it would be a natural reaction to panic. What do they do then? Yeah?
Richard, you wanted to take this one? Because I know that Richard had a few very interesting calls that he had to manage the panic of a number of clients of his. So probably Richard is very, very well placed to answer this question. Rich?
Alec, you asked what's the sort of the demographic of our clients. I would say most of our clients are British expats living here in Spain. Probably the demographic is similar to your own types of clients. So it will be generally retired people, older people. But in terms of did they panic, I would say no, not in general, not panic, more concern. What was going on, both with health and in economies and the markets, was being very, very widely publicised. The news was talking about it every day. So people did know what was going on. And I think what's happened is that in the first few weeks, people were more concerned about the health side of it. They were obviously concerned about their own money, but everybody knew the markets had significantly dropped. And then, as Tim's already explained, we went through February into March. And as we got to the end of March, we did see a bounce back in the markets. And then for the last 3 or 4 weeks, things have been more stable, more volatile than normal, but certainly more stable than we've seen in the preceding few weeks. I remember a presentation that we had in the office from one of the fund managers a few months ago now, and he was saying, this was before the crash happened, in fact it was last year, but he was saying the only ones who absolutely lose in a crash are the ones who have to sell. So they're the ones who've had to realise the losses that have come through. For others, those who've got the patience, we've seen through the previous crashes, the markets drop, and then over a period of time, the markets will recover. Now, we can't tell how long that recovery is going to take this year, next year, but the one thing we can be pretty certain of is that it will recover over time. As Tim mentioned, I've got a few clients who have had particular circumstances. I've got one client who, just before the real worst of the crash, had agreed to buy a new property, and she was in the situation of either having to make a loss on her as it had dropped down, or losing the deposit that she put down on the house, because the people she was buying from were being quite hardball about it. I think there was more she could have done, but in the end, she negotiated a drop in the price. She's lost on her investment, but she's got the property she wanted. So, yeah, not too much panic. One or two people certainly did, but in the main, I would say it was concern. And now, as we're talking to people, I think I would say generally they're pleasantly surprised to see where their investments are. Tim mentioned 35% down. Even with the recovery, the stock markets are probably 15, 18% down. Whereas generally we'd see that our client portfolios are probably more in the region of 5 to 10% down because of the types of investments that they've been put into.
I would like to add some of my experiences, if that's okay with everybody.
Yeah, we can hear you. Yeah.
Basically, well, as my colleague just said, the month of March has been really complicated, even then with April. But I have to say that towards the end of March, beginning of April, when I was doing reviews with my clients, they also wanted to invest, to go into the market, because they were thinking that, of course, following advice, that it could be a good time to go into there and not to lose, you know, the markets coming back up and of course remain there. So that's my personal experience with some of my clients.
Okay, thanks for that. Thank you for that, Lucia.
Yes. So, Tim, I would like to ask you, well, you have been speaking about these new circumstances and this new scenario. Well, so taking into account the current situation, have you implemented some kind of change for dealing with your clients and for your business in general?
A change, well, a change in our day-to-day operating, obviously, because we're now confined to our homes, so we can't meet in person, obviously. But when you talk about portfolios, investments, then absolutely no. The risk of changing when things are going down is that you'll miss out on a subsequent bounce back. And as Lucia or Richard just mentioned, at the moment when we are reviewing our clients, actually they're mostly pleasantly surprised, depending on when they invested, etc. The losses of the portfolios have nowhere been near the losses in stock markets because of the diversification that we implement. So that's one thing, but also we know that if they're in good funds, actively managed funds, then they will recover, and as long as we have a confidence in the fund managers that we recommend to our clients, and we follow that up, and there's no real changes needed there, then we're confident that we'll keep on making a good return for our clients. Richard, have you made any changes to your clients' portfolios in that way?
Yeah, no, generally no. As you quite rightly said, you know, we have to have faith in the fund managers. We will generally be using, because of the demographic of our clientele and what their investment needs are, we're generally looking at the cautious stroke balanced funds. We're looking at good quality funds, good quality managers, liquid funds being very important as well. So I think we trust in those, and I think where the changes have been made have actually been more at the fund level, where the fund managers themselves are able to say, well, these things within my portfolio, maybe I actually need to tinker with it a bit rather than wholesale change. And we all talk with a lot of fund managers on a regular basis, and I think that's very much the message that has been coming across from the webinars and various other communications that we've been getting over the last 4, 6, 8 weeks. So tinkering, making sure that the funds are adapting to how the markets, how the economies are moving forwards. But funds generally have a strategy over the much longer term. So this is almost, it is a blip. in the longer term strategy?
Well, thanks for that. That all sounds quite positive in my opinion. So, what kind of opportunities can you see at this time when it comes to investing? What would be the opportunities you can see?
As has previously been said, markets are lower now than they were previously, significantly lower. So that in itself means there are definitely opportunities. But from all of this, it's very easy to see there are going to be winners and losers. I think come out the other side of this crisis. Others, the likes of Amazon, technology companies, are actually really, really stronger through it, and you would expect that will become the new normal. So I think looking into the investments, there are going to be opportunities. Tim mentioned about active fund managers. Two types of funds, active and passive funds. A passive fund will generally just follow an index or a market. An active fund relies on the fund manager to do the research, to pick the companies they believe will be making will be better in the future. And we very much feel at the moment that active fund management is the way to go, following an index which might have tourism, oil, some of the things that have been suffering recently, as well as the technology companies that are doing well, probably will not give as good a return as those from actively managed funds.
Yeah, there will be winners and losers, absolutely.
Yeah, can I just add on? I think you mentioned the word long-term, Tim, there, which I think is an important thing. Going into the stock markets or into funds like this should generally be looked at as a longer-term investment. And whilst there could be further drops at the moment, in the shorter term, as time moves on, we very much expect that the longer-term outlook to be very good.
So what do you think? Do you think there will be long-term changes to the way of investing?
Shall I take this, Rich?
Yeah.
I think we'll see a few changes. I think that for fund managers and investors in general, there will be more focus on and it's been an acronym that's been used a lot in our industry lately. I think there will be a lot of focus on ESG criteria. ESG stands for environmental, social, and governance criteria. And it has everything to do with the sustainability of a company, how it operates, and the ecological side of it as well, but equally how relying it is on, for example, long supply chains, etc. So I think that that there will be more focus on sustainable companies, and I think from our perspective, more focus on fund managers that focus on that sustainability of the companies that they're buying into. Within our office, for example, I've seen over the past number of years already an increase in ethical funds, sustainable funds, green funds. These things are absolutely increasing tremendously, and now that our world paused us or forced us to a pause, I think that's only gonna continue exponentially. So I think in that way, investing will definitely be different towards the future. And that's, if you talk about opportunities, where are the opportunities? Then I think that's definitely one of the opportunities, sustainable companies.
Yeah, thanks for that, Tim. So, I mean, we kind of, we're not there yet, but we can see light at the end of the tunnel as far as the health crisis is concerned, and obviously, very sad and tragic figures. But now we're gonna come out of the health crisis, and we're gonna have a serious financial crisis. We're already seeing, as you mentioned before, a lot of people made unemployed, particularly in Spain. UK, for example, hasn't come out of their furlough scheme at the moment. So we'll probably expect to see UK go into a deep recession. So we're really not out of this at the moment. So I'd imagine that many people are really quite nervous about investing. what can you tell them now to give them comfort that basically we won't be going back down to 35% losses in the stock market and things can only get better?
Well, one of the main things is that there's not really an alternative, if I may say so, to investing. We've been in a low interest environment for many years now. If you think the central banks with all their stimulus right now, they've in the US, for example, they took the base rate right down to zero again. So in all the developed markets, their central banks, the base rates are set at zero or next to zero, or sometimes even negative territory. So cash is not an option. So if you look at long-term, your money keeping its value, keeping up with inflation, and inflation is still in the 2.5% per year, which means that if you go to Mercadona, you fill your trolley for €100, and next year you go again, that same amount of stuff that you put in your trolley is going to cost you 102 or 102.5. So any money that you're not spending in the short term, if you leave it in cash at 0%, that's not really an option. So when people are nervous about investing and they see those headlines, they're often not thinking about the risk of inflation or the risk of cash. Now, because inflation, you don't feel that on a one-year basis, but over 5 years, that your money is really suffering and goes down in value. So cash is not an option. People would buy gilts, for example, in the UK sometimes, but gilt yields, I had a look this morning, is the 10-year UK gilt yield. I don't want to get into technical things, but basically a gilt is a loan to the government, and the government rewards you for that. You now get an interest rate on that, or coupon as they call it, the yield is 0.2% per annum. So that's not an option. So where's the opportunity? Equities, asset-backed investments. That's where companies, profitable companies. Now, obviously, as I've explained earlier, that can go that can be very volatile, as we've seen this year. So to go straight into the stock market, buying equities, buying shares of companies, I would not advise our clients to do that, obviously. But that's why there's good fund managers with good track records that have a good, decent process in place, and that's where the opportunity lies. That and as Richard mentioned, there will be winners and losers, and as we've just touched on the sustainable companies, well, if you look at good fund managers, long track records that are able to identify those good companies, that analyze the balance sheets of those companies, then that's the only alternative where there's real gain possible in the investment world, I would say, as long as cash remains or interest rates remain at such a low level. And that's where we've seen good gains in the past. And with diversification, you can reduce those risks. People, when they talk about risk, they think of permanent loss of capital. When we talk about investing, we're not talking about permanent loss of capital. We talk about volatility. And that volatility can be reduced massively through diversification, through choosing the right fund managers. And that's what we would tell our clients, and that's where we hold our clients' hands and make the recommendations really. That's where the opportunity lies. Definitely as long as interest rates remain so low, because that's a guarantee for losing money.
Yeah. So I mean, it's interesting though. So if you've got cash at the bank now, I mean, cash is king, and cash has always been king. That's the famous saying. So, how much cash should you have in your bank, and how much should you invest? Do you have a kind of formula or equation for that?
That's a good question, because there's a rule of thumb for that. And the rule of thumb is that if your general income covers your expenditure, then you should not leave more than 6 months your average expenditure on a bank account. Okay. If your income does not cover your expenditure, so you're living already off some capital for example, then we would say 12 months to be on the safe side, average expenditure. So if you spend 1,000 or you spend 5,000 a month, whatever the figure is, you multiply that by 6 or by 12, and that's kind of the rule of thumb that we're thinking of. Anything more than, anything that you have on a bank will not earn anything. So if you've got, say you received an inheritance or a property, whatever, you've got 100,000. If you leave that on a bank account, that means that you're burning 2,500 a year. That means literally that every month you're burning around 200 euros-ish. So that's a risk. That's the risk of cash at the moment. So cash is king was true before 2007, 2008, when interest rates on the bank were 6%, 7%, inflation was at 3-4%. But we've not been in that world anymore since 2007 or 2008. Since then, inflation has been higher than interest. So, and that's why at the moment, cash, just for your first 6 to 12 months expenditure, that's about it. And what we do then, if you ask how we tackle that, then we would build a plan, we would build a portfolio. We would look at different objectives of clients in relatively short term, say between 1 and 3 years, 3 and 5 years and longer. And then we have more cautious investments and more volatile investments, but with more growth perspectives or growth potential, so that we can make a plan of when people can access their money, etc. And in the meantime, we leave the rest to grow.
Thanks for that. Thanks for that explanation. Very, very useful.
Okay. So, and can you give us some additional advice or tips for investing?
Yes, we can. Richard, you want to tackle this one?
Additional tips on investing. I think Tim's covered a lot of the things here, but
don't hold back, Richard. Don't hold back. We're hungry for some good tips, okay? And it's not the number. It's not King's Troop on the 4 o'clock horse race, yeah.
No, it very much is about making sure that looking at the funds that you would go into, funds rather than individual stocks for a start. Making sure the funds have got a good manager. The manager's been with that fund for a period of time. The fund has been running and has got a good history. Obviously, history is no guarantee of what's going to happen going forwards. And I don't know if people follow the markets, but there's been a very high-profile name, Jonathan Woodford, that was very, very popular a few years ago, and recently he moved companies, took his own funds, took a different way of investing, and has basically fallen foul of that over the last few months. So it is using the history to make sure that the outlook is as positive as it can be. I think diversification is important as well. Diversification comes in different funds, different geographies, different asset classes. So spreading the risk around is one of the basic tenements of building up a portfolio. In terms of individual funds, I wouldn't want to go into that on this call. We obviously have got a number of funds that we look at on a regular basis, form probably the cornerstone of a lot of our portfolios we put together for clients. But each client is an individual. So it's not just take something off the shelf and say, right, that does for everybody. People want different things. They might need income. They might want growth. They might want a higher risk or a lower risk. So all of those things have got to be taken into consideration as you put together an investment portfolio for a client. I don't know if that helped. Or Tim, do you want to add anything else?
I think so. I mean, apart from these tips and this advice in what regards the investing, do you think there's anything else that people could do to get most out of their money? Is there any anything you would recommend?
Well, I think besides investing, I think a lot of it is controlling costs. So it's understanding what outgoings you have. It's looking at those and making sure that they're relevant. Take car insurance, for example. It's one of those things where it's very easy just to renew a car insurance policy on an annual basis. Whereas if you spend the time and shop around, you might well get a reduction. Make sure you're not spending money twice on the same thing. You know, in these times, everybody's watching a lot more television. Do you have Netflix and subscriptions to other things as well? Do you need those? So I think it's a common sense approach, but I think it's got to be about controlling costs, because you've either got money you invest and you're looking for the best return. On the other hand, you've got the money that's going out and you need to keep that as low as possible.
In the tax side, if I may add to that as well, probably.
Yes.
So, that's something that we always look at as well, because that goes hand in hand. Whenever you talk about investing and making a profit or making growth for your money, growth or an interest that you earn is one thing. How that's taxed is another thing, because and the charges obviously as well. When we talk about a return on your money, we tend to talk about the net return. So we look at charges, we look at taxes. And as I mentioned previously as well, we really take this holistic approach. So even residency matters come into play here. People, a lot of our clients were clients that never bothered to become a resident in Spain because they were living here for a long time, and that's literally the majority of our clients. But often the hurdles to become a resident were not necessarily true. So people often think that they would be worse off. And then when we sit with our clients and we go through their situation, we can often prove that, on the contrary, they would even be better off becoming a resident. There are certain advantages that you have. For example, when you sell a property with regards to capital gains tax, etc. Alex, that's your territory more than it is ours probably, but it's that holistic approach. If you think about financial situation of a client, there's a lot of things that come into play. Expenditure, taxes, residency, pensions, retirement planning, all these things are interconnected to one's financial situation.
And regarding the communication with your clients, and due to the current situation and the lockdown, how often do you get in touch with them? And do you think it has changed over the course of the lockdown? And also, of course, we are using media a lot nowadays to communicate. Which media is the one that you normally use with your clients?
Can I take that question, if that's okay?
Yes.
Okay, thank you for the question. So basically, the way of communication with our clients before this happened has been agreed during the meeting, basically, during meetings with them at the beginning, initially. So basically, sometimes they like just to see us once a year, or they like to have regular valuations from the investments that they have with us, or they like to have more news from from the political point of view or from the economical point of view. So of course it's down to them just basically to ask us what they want to receive. So yeah, I was saying that the approach that we have taken over during this lockdown has been being proactive, just to get in touch with them before they were looking at the news, reading all that bad news, as Tim was saying before, with the situation, with the economical crash, with all the markets going down 30, 40%. That's what really clients get into their heads, just the 30, the 40% down and nothing else. So they thought, or they think, of course, oh, I'm losing straight away that amount of that percentage is going to be affected straight away into my portfolio, which surprisingly for most of them, as we already mentioned before, they haven't, because of the diversification. So one thing is to have a market crash, And another thing is the fund manager, that's why we pay for that, within the fund, just to do his job and try to make that as smooth as possible, not to get down to the floor as all the markets in general, just to look for opportunities. So basically that's the approach that we've been taking. How often do we contact them nowadays during these 61 or 62, I forgot which we are in now? Well, I would say at least once a week. From my side, being Spanish, I'm all the time with the news on the TV and the radio. My daughter is just fed up with all the news, but that's our job, unfortunately. So I try to give them the update. Okay, are we still in phase 0? Are we still in phase 1? Different areas, different provinces. People just get confused, you know, with autonomous communities, with provinces, with Canary Islands, Balearics, Catalonia. Where am I? So of course we need to be really on the top of that. So I like to get, you know, a brief email just to send throughout clients in general with bullet points, just specifying what is, you know, where we are at now. And today, for example, the last one that I sent today was just basically looking forward to hear what the minister of our health minister is going to be saying about phase 1 or phase 0.5, as they are calling it now for Madrid. So yeah, it's a bit of a complication, but let's see. The main thing is just to keep our clients updated all the time before they just, or they cannot sleep, or they can, I don't know. I had, you know, a few conversations with all of my clients, and everyone says something different. And the main thing is just, we are paid to keep the worry with us, or to get their worries out of their head. That's our job, basically. So anything that we can clarify that straight away over a call, over a Zoom, over a Skype call. So nowadays, really easy.
So are you using Zoom a lot more, or kind of face-to-face webinars like this, Lucia, to communicate with your clients?
Yes. Well, Zoom I'm not using too much with clients, because for one reason or the other, most of them, they do have Skype. So of course that has been straight away the main way of communication. And I like to do face-to-face myself, because I need to interact. I'm very Latin, being Spanish. I'm playing with my hands, and the face shows everything. You need to, you know, when you are positive, you also, of course, through your voice, you can feel the positivity or the negativity of your situation. After 2 months of being at home, most of the people are alone. So not everybody's been able to interact with more people, or no kids around, no pets. So it's been complicated for a lot of them.
Yeah, no, thanks for that. So one of the things Tim touched on residency. He said, yeah, we are helping a lot of people become resident. A lot of those involve British people at the moment who wish to move to Spain and make Spain their permanent home. The police stations are closed at the moment, so we can't do much in respect to the police station, but we are preparing those applications. And one of the points that always comes up when we're talking to them is that if they've sold a property in the UK and that was their main home, do not become a resident in Spain until you're out of the Spanish tax year, so they don't pay capital gains tax in Spain on the sale of their UK property. So that's something that really we cover quite carefully with our clients. Generally, we've got a few minutes left. So if anyone has got a question, just kind of please do feel free to ask that. Generally, Tim, in the Black Tower team, have you noticed or experienced an increase in demand for your services during this period?
Difficult to say. We've seen so over the past weeks. Initially not. I mean, initially, as Richard mentioned, everyone was very concerned with their health and the implications of that. We did see now an increase in inquiries. People with cash that's not invested do see the opportunities. We get from existing clients or referrals, we get people inquiring about investment opportunities indeed. And in general also, obviously, we've got Brexit still coming at the end of the year. So that's been hot on the agenda for within our company for having organized seminars around the topic. for the past 2 years or so. And that's again becoming more and more on the surface an issue. What's going to happen? I haven't got my residency yet. Is there going to be any changes there? So we do get inquiries around that. Yeah, so Richard or Lucia, have you seen an increase yourselves?
I would say, well, the first few weeks, couple of weeks, it was more a matter of us getting in touch with our own clients. Then I would say from the beginning of April till now, and recently even more, there has been an increase in questions. As you said before, Alex, like, yeah, if I sell the property in the UK and I'm here in lockdown, what should I do? Or how can I behave? You know, how can I go about the tax implications when becoming tax resident? So it's all about questioning and having the right information in place to establish the what I need to do right now, or when I'm able to go out, to have everything correct. So yes, it has been an increase on that. And as I said before, some clients that had money in the bank or had money within cash sat there, they wanted to give it a try. Why not? I mean, of course, it hasn't been the end of the world, and it's not going to be the end of the world. We have been living and seeing many crises and crashes with the markets, and it's a cycle. We need to bear that in mind, that everything that goes down has to go up again at some moment. So if you can benefit from that, then why not?
Richard, did you want to add anything to that?
I would just add, I totally agree with what Tim and Ruth here said. Over the last 3, 4, 5 weeks, the number of questions, the number of queries that people are asking has certainly risen, and has become broader as well. I think people are looking at what's coming next from their own point of view and how their investments are working for them. You know, maybe things need to change. Maybe they had an income stream which is now dried up more, and they need some cash. And so there's probably questions around when or how do I realise some cash from my investments. Alternatively, as Lucia has just said, people who've got cash available are seeing the opportunities to invest. So, yeah, very much so. Over the last month, quite an increase in contact from all our clients and from people and prospects who maybe we've been talking to in the past, but not yet have become clients.
Yeah, sure. So Alison's question earlier was whether you've seen, like in 2008, you've seen a flight to commodities. Are people, you know, shying away from equities and moving into commodities, and, you know, particularly gold? Are people looking at buying more gold and holding on to the safety items that hopefully will increase in value as well over time?
Shall I take that, or I'll give my and then I'll pass it on to Richard and Lucia. Commodities is a very broad term, and when you talk about commodities, we've got also iron and all these industrial materials that are part of that. And commodities can be very volatile. And especially when global demand is at stake or is questioned or is expected to decrease, then commodities tend to react to that exponentially. And so and I think definitely for now, I think the commodities are an area or an asset class not to be exposed too much to that, because we don't know when the economies are going to be fully functioning again. Gold is a very particular one, because Warren Buffett has an interesting view on that, and it's called the greater fool theory. And the greater fool theory means that the price of gold increases as long as there's enough willing to pay a higher price for that as you've paid for that. So that's so that's what makes the price of gold move. If you would take all the gold in the world together, then it doesn't produce anything. It's not, for that same amount, the analogy that he gave, you could buy all the crops in the US, you could buy so many oil companies that have a cash flow, that are producing, that are growing. So it's typically a safe haven when markets are volatile, but in the long run, I don't expect gold to give the same profits at the moment as equity markets. Definitely not from the level where we are right now, where there's perhaps an opportunity that we will look back at in a few years that only happens once in so many years. So the level where we are right now in the stock market. So at the moment, we don't see that. To touch on, have we made any changes to our clients' portfolios? No, we haven't. We're confident that the funds that they're in will recover, that managers will do their job. And from an asset class perspective, as I mentioned earlier as well, there's not really an alternative with cash having a very low interest rate yet, and commodities having the risk of being very volatile. Something you want to add, Richard?
No, I don't think I've got anything to add to that, Tim. I think you're quite right. I certainly haven't seen any desire from clients to move more into commodities, and for the reasons you've given, actually, it's not something I personally am recommending to them.
I think also the demographics of our clients here, as one of my colleagues mentioned earlier, they're more in a cautious to balanced spectrum, because most of our clients are nearing retirement or in retirement, where commodity investments tend to be on the higher risk spectrum. So I think it's not really applicable to demographics of our area, you know.
Okay. Well, thank you very much, everyone. We've kind of run out of time. I'm sure it's certainly a very interesting subject, and I think thank you for answering all those questions. As I said, we're going to record this and place this on our social media, and next week we will be joined. Next week we'll be talking about buying property in Spain. So feel free to join us then. That's another form of investment or not, depending on your approach. We'll be joined then by estate agents. David Jackson from Jackson Grundy in the UK and also here in Spain, and he's going to be talking about the UK market coming back and the Spanish market here. And we from the My Law in Spain team will be talking about the buying process and things to do and things not to do. But from me and from the My Law in Spain team, thank you very much for joining us today, and we look forward to seeing you all soon.